Today we're going to talk about a company called VF Corporation. And while we typically cover tech stocks here at Nanalyze, the majority of our money is actually in a dividend growth investing strategy called Quantigence that I spent a decade developing and refining with one of my colleagues who I worked with in finance. And VF Corporation happens to be one of the dividend growth stocks that we're holding, and it's currently at a yield of 6% to 7%, which is remarkably high, and we wanted to talk about why that is. So before we get into that, I wanted to point out what this young lady is wearing. So in that region of the world, they wear lots of fur, and the reason for that is because it's very cold, and fur is very different from cotton. Primarily that cotton comes from plants, while fur and wool come from animals, so they have superior properties. And some of you might know I'm quite a traveler myself, and I pack a very small bag, and in that bag everything is made out of Merino wool, and that's because Merino is a soft wool breed that has properties that are rather remarkable. So it's 6 times stronger than cotton. It's naturally odor resistant and UV resistant. You'd be surprised how long you can wear a wool shirt without having any odor. It adjusts to temperature, so if it's cold out or if it's hot out, it will breathe in response to the temperature outside, and it can save your life. So if you've ever fallen into a cold river and gotten out in a cold environment in a cotton shirt, you'll know what that feeling is like. You start to freeze very quickly. Well, if you do the same thing when you're wearing wool, it won't have that same effect, so it can actually save your life. So wool is a miracle material that makes up 2 of the brands that I spend a fair amount of money on that VF Corporation offers. Those are Icebreaker and Smartwool. And you can see here some of their other brands, more popular ones being Timberland, Dickies, and of course North Face. That's a big brand for VF Corporation. And they're one of the world's largest apparel, footwear, and accessory companies. And they operate as a portfolio of clothing businesses. So they'll sell some brands, they'll buy some brands, and they manage that portfolio over time. Now, one of the problems they run into is that there are a lot of duplicates out there. So this is a great picture that I took. This was back, I think, over a decade ago in a place in the world called Tiger Leaping Gorge, where I found an interesting growing plant, and I stuffed it in my new North Face bag that I had bought at the market there for about $10. And not too long after buying that bag, the zipper stopped working. It started falling apart, and it was total rubbish. But you can buy North Face gear at any market in China, and of course it's fake, and the quality is absolutely rubbish. But people don't know that, and North Face has to compete with problems like that with their brands. So that's one of the places they do business. And of course, the Chinese are rather sophisticated consumers, and they're starting to learn the difference between fake North Face and real North Face. But the company itself happens to be a dividend champion. Not only that, but they're a dividend aristocrat, meaning that they've not only increased dividends, let's say they not only paid them, but they've increased dividends for this year would have been 50 years in a row. That's remarkable. So here you can see this is part of our dividend growth investing strategy, and this is a table which shows the companies ranked by our proprietary Q score, which takes into account all these different variables. And in third spot there you see VFC. Now there's a bit of a debate going around right now as to whether or not VFC is an aristocrat, and that is a company that's increased dividends for 50 or more years in a row. And this past October, VFC increased their dividend from 50 cents to 51 cents. That's an increase of just 2%, but an increase nonetheless. So the debate is around the separation in 2019 of contour brands, and they did this sort of a spin-off. And while we typically don't count special dividends as dividends, in this case we do, which means they were able to maintain that track record. Some pundits would exclude them as an aristocrat, whilst we consider them to still be an aristocrat. So this decline in share price, and it's declined rather dramatically. I would imagine more than 50% since year to date, though we don't pay much attention to stock price in our dividend growth portfolio. We mainly pay attention to things like yield and dividend increases. But if you look at this chart here, you can see how their yield is at an all-time high. So the chart on top there shows VFC. You can see that yield over the past, close to a decade, they haven't had a yield exceed 6%. Well, it finally has, and there's usually a good reason for that, and it's that investors don't believe they'll be able to sustain that dividend. You can see below that a nice chart showing J&J, and a lot of people say, well, I'll only buy J&J when the yield's over 4%. Well, the yield never hits or goes over 4% because there's a certain support there for quality companies. Investors will step in and pick up shares of quality companies when the yield starts to peak. And in the case of VFC, that's the question here. Isn't this a great time to pick up shares for a depressed company? Well, that's what we're going to try to answer today by looking at the likelihood that they can continue paying and increasing that dividend over time, no matter how small the increase might be. Here you can see their revenues, and I've circled a section there most recently that shows how their earnings are going negative. Well, when you have negative earnings per share, how can you possibly pay dividends? Well, there's some basic ideas here that we need to discuss. The first being payout ratio, which is the percentage of profits or earnings per share that get paid out to investors. So when you have negative earnings, you have a negative payout. You can't even have a ratio because there's no money to take from. So it's best to think about dividends simply being the movement of cash from the company. They take cash that they have and they give it to shareholders regardless of what happened with earnings. Every company has a cash balance that's independent of their profitability. Now, the other concept here that's important is free cash flow. That's the cash that's generated by a business that they use for different things based on their own operations, all right? And then from that, you can move down to earnings, which takes into account a lot of different other things. Accounting becomes very difficult sometimes, and you need to peer through all the rubbish to try to figure out how able the company is to pay their dividend. So just to give you an idea of free cash flow, this is a look at NVIDIA. You can see in 2022, they had $8 billion in free cash flow, and they paid out $400 million in dividends. Sounds like a lot, right? But when you break that down per share, it isn't very much. Their yield's quite small. Why even pay it? Well, maybe they're trying to start establishing a track record. And you could see here, based on that free cash flow, their payout ratio is very, very low. The percentage of that they're paying out in dividends, 5%. And the other bits of cash there, they repurchase shares or they invest back in the company, which is what we want to see a growth firm like NVIDIA doing. So when we look at VF Corp, here you can see revenues versus their total costs, and we often look at gross margin as an indicator of the strength of a business. And here we've simply taken a look at total costs without taking into account impairment of goodwill. And we've written extensively about what that involves. And I'll put a link to a piece that describes how goodwill works for those that may not be familiar with it. But if we remove that element from their financials here, you can see that the adjusted operating loss they have is $4.9 billion, and it actually moves them to a positive adjusted income. So when we remove the impairment, the picture's a lot different. So what we can do here is simply back the dividend payment out. So we can say that they returned cash to shareholders. This is a statement. So if you just read this bullet point on the top here, this is taken from their last earnings call. It says, returned cash to shareholders through the dividend of $194 million and improved an increase of 2%. So they paid 50 cents per share. Remember we said the increase was to 51 cents. They were paying 50 cents before. So 50 cents a share means they paid out $194 million. That means they paid on 388 million shares outstanding, and that adds up. That's actually correct. Their new dividend is 51 cents a share. That would be $198 million. So for all practical purposes, we need cash flow of about $792 million a year to keep that dividend going. Not to minimally increase it, just to keep it going based on the most recent increase. So when we look at their fiscal year 2023 outlook, again, fiscal is so confusing, but if you think about that as this coming year, you can see here where they revised their guidance, and this is part of the reason their shares took a beating recently. You could see they adjusted earnings per share downwards, and Cash flow from operations, you see how that went from $1 billion to $900 million? Well, that starts to squeeze, right? Because they need $792 million for the dividend. And if they tell you here, we need $230 million for capital expenditures, that total actually puts them in the red at about $122 million. Well, where can that come from? Well, it could potentially come from cash. You can see here that they have a cash balance of $552 million. So they can start to dig into that. They can also use debt to fund the dividend. But I wanted to also point out one other thing here. That's finished goods. You see how their inventories are increasing like that? When you see inventories get that high, it's because goods aren't being sold. And the company addresses that in their recent earnings call, talking about how some of that is attributed to changes in supply chain financing. So that's understandable, but it's certainly something to keep an eye on. And what it means is that they'll have to start discounting products in order to start reducing inventory. So when we look at liabilities, Moody's put out this very interesting piece here. Moody's is a firm that provides commentary around the quality of debt for large companies out there. And you can see here they say Moody's changes VF Corp's outlook to negative. So that means that they are starting to have some concerns about VF Corporation's debt, even though it's a quality company. And we've extrapolated out some of the key points here. Weaker than expected near-term operating performance expectations. The old macroeconomic headwinds are affecting VF Corp the same way they're affecting anybody else. The difficult operating environment, higher than expected debt levels. So the way that they'll look at that is typically through ratios. And here you can see they do this debt to EBITDA ratio. And it's not important to know how to calculate that. It's just important to know there's a ratio in that. The benchmark is 2.7, which is commensurate to VF Corp's rating. Well, right now, VF Corp's at 3.5. So over the past 12 months, it's been 3.2. And because of this Timberland tax payment problem they've had, again, short-term, nearsighted performance problems, they've had to draw on a term loan, and that ratio is now 3.5. So they've also had problems with their most profitable brand, Vans. There's a slower than expected recovery in China because of the Rona, though China is increasingly laxing their rules, fortunately. They talk about elevated inventory levels, again, what we pointed out, which leads to promotional sales environments, especially around the holidays coming up. Hopefully they can get rid of some of that inventory. And then increasingly challenging consumer spending environment, of course, and this $2.25 billion commercial paper program. Commercial paper is quite tricky, and if you don't know how that works, it's not important, but it can get you in a whole lot of trouble. So that's a very creative way to unlock value in a supply chain, but it also increases risks, and Moody's noted that. So just to conclude, macroeconomic headwinds are impacting VF Corp, and we'd all like to believe, as Moody's does, that these are short-term issues that this company that's been around since 1899 and has been able to increase a dividend for 50 years in a row now will be able to weather this, and that these concerns that we're seeing right now, the high yield reflecting a very reasonable valued dividend growth stock, are because of this uncertainty. So our belief is that when you have a company that's increased their dividend for 50 years in a row, they'll go to great lengths to protect that. So a dividend cut will be a last resort. And navigating this crisis, if they're able to do that, will represent an excellent opportunity to add a quality company at a steep discount. So please put your comments in the comment section. Make sure to subscribe to our channel. Thanks for taking the time to watch this video today.